Explainer 3, Inflation, Noise Suppression. Hi, John Rothfield with Derivative Logic. In its periodic statement of goals, the Fed has described its inflation target cautiously. Specifically, that its target of 2% is to be achieved over the longer run. What you will usually see is that when 4 times a year the Fed publishes its quarterly economic projections, is that they show a pretty smooth path toward their 2% destination over a year or two rather than right away. In other words, it isn't going to react to each month's rise or fall. It wants to, what they call, look through what it considers to be transitory elements of price changes. But the Fed cannot be complacent either, because one inflation print can suddenly become a series of consecutive surprises, after which it becomes more difficult for the Federal Reserve to correct course. Thus have arisen various efforts to control for noisy components of inflation. The simplest of these is to exclude food and energy, the remainder being the so-called core rate of inflation. Fed Chair Jay Powell has also acknowledged a supercore inflation rate that excludes food, energy, other goods, and housing. The first 3 of these are volatile. The 4th, ironically, is excessively smooth. Economist Paul Krugman even once coined the term super-duper core that additionally excludes used car prices, which during the COVID pandemic episode blew up and became very volatile. What's left after the most extreme of these exclusions captures only about a quarter of the inflation basket. But it is thought to contain some material insights on the relationship between costs like wages and consumer inflation. Now, another source of information on taking out the noise is that various regional Federal Reserve banks publish measures of underlying inflation consistent with international practices. They do more than just make simple exclusions. For example, the Cleveland Fed publishes 2 of these each month, a few hours after the official CPI report. One is the 12-month change for the median item in the CPI basket, which of course changes every month. Another is to trim away the basket's fastest and slowing moving components. Cleveland Fed's trimmed mean measure excludes the most extreme 8% of the monthly price changes from both tails of the CPI basket, and that's called the 16% trimmed mean. The Atlanta Fed publishes each month a CPI breakdown into items that are deemed flexible and those that are deemed sticky. It is these slow-moving items, which represent about 70% of the CPI basket, that are more relevant for forming a view on medium-term inflation. Again, please let us know if you have other topics we should cover in our Explainer series.